And the markets have not made any headway since they celebrated the dovish Federal Reserve last week. We are left to wonder, well, what gives? What exactly seems to be going on here that investors don't find any more joy, having been so thoroughly cheered up by what the Federal Reserve had for us on Wednesday? This is macro money. We are once again looking at what these markets are doing here this week. I'm Ilya Spivak, head of global macro here at tastylive. As we do every Monday, we're going to look at the week ahead, and a strange week it is, in macro drivers that might well give us a guide on what's going to happen here next. But before we do, a bit of stage setting. And this really is where we really ought to, I think, begin our conversation before anything forward-looking comes to mind. And that is to ask, are these markets now out of catalysts? Have we exhausted scope for these markets to continue building higher? And this is why we're going to look at this. If you look at the performance for the major assets last week, the story appears wholly unmistakable. Stocks are up. S&P up 2.1%, NASDAQ up almost 3%. Yields are down. The 10-year down 2.5%. The 2-year down 2.9%, almost 3%. Even there alone, the story seems very straightforward. On Wednesday, we got a Federal Reserve that told us growth and inflation expectations as we see them have been upgraded. This is the first adjustment in the Fed's official forecasting since December. So needless to say, this is an important, fateful sort of moment. And the Fed says, we think growth is going to be faster. We think inflation is going to be hotter. And also, that does not translate into fewer rate cuts for us. We told you we looked at 3 as likely in December. We still see 3 as likely in March, despite growth and inflation upgrades. Not surprisingly, the markets looked at this and said, well, this is dovish. The Fed is not responsive to data surprises that might be pushing them into a less dovish direction. They are resisting, and they're saying, no, we said 3. And when asked specifically about this in the press conference following the FOMC policy announcement, Fed Chair Jerome Powell said, yeah, these upgrades reflect data that's already been out. And of course, U.S. economic data has tended to look relatively better than expected since the beginning of the year. That much we know here on Macro Money. We've been following it from data point to data point. And so with that, Powell seemingly said, well, these upgrades that we just did, they're old news. That's not forward-looking. Don't extrapolate that. Oh, and by the way, we're looking to slow down quantitative tightening, the program where we let assets run off our balance sheet, which is a kind of stealth hiking of rates or a further sort of tightening of monetary policy running in the background, even though the Fed hasn't actually raised rates for quite a few months now. A kind of slow, cautious tightening of credit conditions continues because the balance sheet continues to run down. And so what the Fed told us here is, don't worry about the upgrades in the forecasts. We're still going to cut 3 times, we think, and we're going to need to slow down the pace of this back of the stage tightening, as if to say, no, we're really skewing in the dovish direction, not the other way. So not surprisingly, front end yields and longer end yields fall, but the front end does most of the falling. Stocks cheer. The dollar weakens, initially at least. But then something strange occurs. So when we look at this at face value, it seems to make sense, except if we look at 6E here, that's the euro, a kind of proxy for the direction of the US dollar. The euro, of course, is its most liquid counterpart. The euro is down for a second week and is down more than the week before, almost 1%. In fact, the dollar was up against all major currencies with the exception of the yen, at least for a bit. The Bank of Japan seemed to be the much bigger catalyst in the yen. It fell 1.7% and largely stayed motionless for most of the week thereafter. And we'll dig into the Bank of Japan here momentarily. But on a week where there seemed to be an unequivocally dovish Fed narrative, gold, which yields nothing and loves nothing more than a dovish narrative, could not rally, and the dollar rose. Crude oil continued to largely do its own thing, but the signaling from rates markets to stock markets to currency markets, even to crypto, where Bitcoin fell 7.5%, seemed to be at a disconnect. It gets even more overt if we look at what happens after the Fed announcement occurs. So needless to say, when the Fed comes out, the markets have their dovish reaction. But if we look at what then happens Thursday, Friday, the 2 days immediately after the Fed announcement, where there isn't really any more major event risk to shape this narrative and every opportunity for momentum to build, it doesn't happen. The S&P 500 returns nothing extra in those 2 days. NASDAQ manages to eke out 0.2%. So stocks are flat, standing still after this Fed announcement's initial reaction is run out. Yields continue to fall, but in a strange configuration. The long end falls more than the short end. So the markets don't seem to then be still making the adjustment to an extra rate cut at the front. Rather, it seems like safety-seeking capital is buying longer-dated bonds, and so those yields are falling more. Crude oil comes off a bit. Not much to say there, in that it continues to kind of oscillate to the beat of its own drum. But gold sees a dramatic decline. The dollar sees most of the week's gains. Notice here, it's up 0.8% on the euro and 1.1% in 2 days after the Fed. So we can see here that the dollar actually fell on the Fed and a little bit before, and then most of that 0.8% was the last 2 days of last week. The yen is motionless, and Bitcoin does most of its falling after the Fed, down 5.9% in those last 2 days out of a 7.5% decline. So the markets ostensibly heard a dovish Fed, had a knee-jerk reaction, as you might expect, and then stopped on a dime, making no more hay of it for the rest of the week. And this, needless to say, is eye-catching. Because if, in fact, the markets were so very enthused by the prospect of Fed support, they certainly did not show it beyond a few hours following the policy announcement crossing the wires. Here's what we find within our sort of framework of benchmarking risk sentiment against the cost of money, and the driving force of that, of course, the Fed policy outlook. In the green line there is the Fed's December benchmark of 80 basis points, which was left unchanged with this policy announcement. So we can say December, we can say March. This is still where we're at. The Fed is unchanged. The gray bars are the priced in rate cut expectations as they appear in Fed funds futures for this calendar year. And in the blue there is the S&P 500 as a kind of benchmark for overall risk sentiment. We can see in relatively clear terms here what is driving the rally in stocks since it begins in late October, early November, because we can see that this is precisely the time that the Fed policy outlook starts to swell with rate cuts. And we go from about 3 baked in for 2024 right here out to as many as 6. Now, of course, the Fed was not admitting any rate cuts really at this stage in the game. They really signaled that rate cuts were coming with the November 1 policy announcement, and then later in December actually quantified how many were likely on the menu. So the markets had lots and lots of room to speculate here, and ultimately arrived at 6 cuts. Then in late December, the Fed said, okay, 3 is what we're thinking. And so begins 2024 with a wide gap of 3 cuts in between where the markets are, which is down here, and where the Fed is, which is here. Ostensibly, the markets then are saying, we're right, the Fed's wrong. It's going to have to come our way on this, because obviously, if we didn't think that, we wouldn't be pricing in what we are showing in markets. So we clearly think it's going to be more cuts than the Fed has thus far acknowledged. So money is going to be cheaper. There will be more of a dovish adjustment in the Fed's stance. Risk on. And stocks keep rallying. As a matter of fact, they keep rallying as better than expected economic data that we just mentioned keeps coming out, and the stock of rate cuts shrinks. Just until we get to the point now where we've essentially reached alignment. With the latest Fed update, the Fed and the markets are basically of a mind. In fact, the markets are holding slightly to the hawkish side of Fed expectations. They're looking at 70 basis points as of today being baked in. That's against expectations from the Fed of 3 cuts. So what we're ostensibly looking at here is a narrowly less dovish perspective from the markets, but still more chance of that 3rd cut than the other way around. So if we consider here that 20 of the 25 basis points of that 3rd cut are in the market, so 70 rather than 75, then we're looking at an 80% chance that 3rd cut occurs. So we are effectively lined up here. And the question naturally then becomes, well, if the catalyst up through here was that the Fed will at the very least have to adjust somewhat to a more dovish setting, be it here where the rate cuts are first building out, to then here, where there's more of them in the market's view than in the Fed's, now we have officially arrived. And you can perhaps rationalize this additional increase in the S&P by saying, well, we didn't have an update from the Fed yet. But now we have. The December dots and the March dots are the same dots for this year. And by the way, even though the S&P has been rising, the NASDAQ, which we don't have on the chart here, and which ostensibly has been the leader of this rally, has actually been stalling for the better part of a month as we reached this stasis and this alignment. And so, not surprisingly, the question then becomes, well, if we're in alignment, what exactly is it that stocks have to keep them going higher? If this rally was truly predicated on the prospect of cheaper money in the future, there is nothing else seemingly to price in here, at least until we get another big piece of economic data that wildly misses expectations, and the markets can go off speculating that we are going to have a more dovish Fed, and the data will force them that way. But there is no major U.S. economic data that's immediately on the menu to do that. And of course, nothing is to say that it's necessarily going to miss relative to expectations. The latest update that we got on this was U.S. Purchasing Manager Index data, PMI data that we saw last week, where we saw a third consecutive month of generally positive growth that was neither accelerating nor decelerating from a baseline that's been established for about 3 months now. And so the U.S. economy is seemingly in cruise control. And the question then naturally becomes, well, what then is the tailwind? And is there then room for profit taking on some of this narrative that makes stocks vulnerable, not necessarily because anything is wrong, but because the story has run out of gas? And that is the question that we are going to be asking ourselves this week. Now, of course, the most potent indicator in the stew here when it comes to Fed policy will be the PCE inflation data that we are going to get on Friday. Fortunately, on Friday, we are also going to have market closures. Fed Chair Jerome Powell is also due to speak on Friday. He's going to be having a sit down with the Federal Reserve's San Francisco branch, my home branch. But the markets will not be open to have a reaction. Now, over-the-counter markets, like, for example, foreign exchange, they will be open because there are no exchanges that open or close there. But because it will be the Good Friday holiday for almost every major liquidity center around the world, and Europe will remain closed for much of Monday and into Tuesday next week, then you find that liquidity will be very scarce, even in OTC markets. And so getting a reasonable reaction to whatever this is going to have to wait. So there really isn't an immediate catalyst here. Now, looking at the numbers from the Bureau of Economic Analysis, dissecting this data, and this is a dissection done by the San Francisco Fed, we can see here that food and energy are essentially not a factor. Housing has been slowly easing as a factor, but the main story continues to be core services. And that's just straight economic growth as driven by consumption, the bedrock of the economy. And here, again, as we just saw in the PMI data, we seem to have relative stasis. So the idea that these numbers are going to bring us anything game-changing is probably overstated in general, but in any case, if the Fed is telling us that they can upgrade growth and inflation forecasts and stay with their outlook, then perhaps that there isn't a data-sensitive reaction function here in any case. And so perhaps the narrative is truly over. And the next one waiting to begin. What that next one is, time will tell, but a period of profit taking on the blistering rally that we've seen in stocks already is certainly not out of the question. Elsewhere on the docket, we're going to have minutes from the last monetary policy announcement from the Bank of Japan, as promised. Here we are with the Bank of Japan. Last week, they exited negative interest rate policy and finally sounded the end of yield curve control, the policy where they were capping the 10-year Japanese government bond yield at 0%. Both of those things were overwhelmingly expected. And so the yen roundly sold off, even though here was one major central bank, the only one that isn't tightening, but that isn't cutting rather, but tightening. There wasn't really anything else to say. Speculation had become reality. It was about as classic of a buy the rumor, sell the fact sort of a reaction as could be. Certainly didn't hurt that, as we've been talking about here on Macro Money for the better part of 2 years, there is really no strong impetus for the Bank of Japan to tighten in a hurry because they face structural disinflationary and deflationary forces that largely rely on demographics and that aren't going anywhere. And the Bank of Japan said as much. They said, here's a bit of tightening, but we're in no hurry to keep going. This will make minutes from that meeting very, very interesting because the markets, not surprisingly, are now saying, okay, well, let's get a better sense of this reaction function. How sensitive are you to economic data if that data suggests that, in fact, the economy is reaccelerating and things are heating up? You've just had wage negotiations where you've locked in significantly higher wages for the next fiscal year. So how responsive are you? And might you put some more tightening on the table? As we see here, at this point, the policy rate is at 0. We expect a hike of 10 basis points within the next 6 months. We expect to be up by about 2 of those 1 year from now, 3 2 years from now, 4 as the outlook runs out here, give or take. We're looking out 3 years here. So looking at these minutes should be very interesting. And if we look at the way Japanese economic data has recently performed, it's increasingly improved relative to expectations so far this year. Looking at the Citigroup Economic Surprise Index for Japan. We also happen to have retail sales and industrial production numbers as well as CPI for the Tokyo region on tap this week. If it follows, if those releases follow this pattern here, and we get hotter results along with BOJ minutes that signal that perhaps the Bank of Japan is open-minded to picking up the pace a little bit, the yen might have room to rally. And finally, we're going to get over the weekend here, heading into next week, Purchasing Manager Index numbers from China. Expectations are that the service sector will accelerate while manufacturing is almost back to even. 50 is no growth, no contraction. We've been in contraction mode for months. Expectation is we might finally climb out of it, or at least almost climb out of it. We can see Chinese economic data has basically been hugging the 0 line when it comes to their economic surprise index. So expectations and reality have been basically aligned. But of course, how the world's second largest economy fares is a key question if the Fed story is in fact exhausted. So it'll be key to see what happens here. And that is Macro Money for today. As ever, we're here every Monday through Thursday after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, where we look at the Wall Street close and what may happen thereafter. I'm back on with Chris for Futures Power Hour on Fridays, although not this week. It's a market holiday. I'm back on first call with Tom and Victor on Sundays, writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.